Saving $10,000 to invest is an impressive accomplishment, since you certainly don't want this money to go to waste. How you invest it is important. One of the most common mistakes made in this situation is making complex or high-risk investments in the hopes of getting rich quick. In a world where the cost of living continues to rise and the future seems more uncertain than ever, the idea of investing your money wisely becomes more than just a financial strategy. It's a lifeline. But investing isn't just for the financial elite or Wall Street magicians. It's a path to achieving your dreams, a path that anyone with $10,000 and a little determination can take. In today's video, we will tell you about 10 ways to invest your $10,000 in 2024. But before we get into the video, make sure you subscribe to our channel and press that bell icon to never miss an update. Now, let's get into the video. Number 10, invest in CDs. Certificates of deposit, CDs, may seem like a thing of the past, but they're a proven way to protect your money and enjoy predictable returns. With CDs, you essentially promise to hold your money on deposit for a set period in exchange for an agreed-upon interest rate. It is a safe and stable investment option, offering higher returns than standard savings accounts. However, it is essential to note that CDs have their own set of rules. Although they are relatively low risk, they offer lower returns than more aggressive investment options. Additionally, they may be less liquid because you determine how long your money will be tied up in a CD. If you need to withdraw your funds before the agreed date, you may incur a penalty. However, CDs can be a reliable option for investors looking for safe and stable returns. Number 9, consider money market funds. Money market funds invest in short-term, low-risk securities that provide stability and liquidity. They are one of the best ways to invest $10,000 for conservative investors looking for modest returns while preserving their capital. Returns on money market funds are generally lower than on high-risk investments, but higher than on high-interest savings accounts. Some money market funds aim to attract institutional money with a high minimum investment amount. However, other money market funds are retail money market funds and are accessible to individual investors due to their small minimums. The primary objective of a money market fund is to provide investors with a safe way to invest in safe, highly liquid, cash-equivalent debt assets using smaller investment accounts. Number 8, pay off high-interest debt. Invest in your future by tackling the high-interest credit card debt you currently have. Plastic in your pocket is one of the most expensive ways to borrow money. The average American has 4 cards. 52% of active cards carry a balance, with the typical cardholder having a balance of around $6,600 and an annual percentage rate of 16.44%. Pay only the minimum payment owed on these cards and you'll enjoy a repayment term of more than 9 years and pay almost as much interest as you owe on your cards. Consider paying off that high-interest debt instead. Once you've done that, you can start funneling those past payments into income-generating investments like stocks, index funds, or real estate. Instead of paying interest to your lender, you'll turn things around and have the power to start earning rewards on your investments. Number 7, invest in a high-yield savings account. High-yield savings accounts are like a financial sweet spot. This is the perfect place to store your emergency funds and other savings goals. These accounts are not only safer but also offer greater liquidity compared to many other investment options. The main benefit of a high-yield savings account is getting a much better interest rate than you would get with another savings option. The rates on these accounts can easily exceed the rates offered by traditional banks, and when interest rates are low, every penny you earn in interest counts. Aside from that, high-yield savings accounts could save you from paying fees. These accounts are typically offered by online banks, which generally do not charge monthly maintenance fees. This is because online banks tend to have lower overheads than their traditional banking competitors. As such, they can pass this on to their customers in the form of lower fees and better rates. Number 6, invest in your retirement account. Investing in your retirement account isn't just about preparing for your golden years, it's about getting tax benefits and preparing for a stable financial future. Retirement accounts, such as Roth IRAs, 401ks, and health savings accounts, HSAs, offer tax advantages that make them an attractive option. It is advisable to prioritize these accounts after securing your financial fundamentals. Roth IRAs, for example, allow you to contribute money after taxes, which then grows tax-free, and you can withdraw tax-free in retirement. To be eligible to contribute to a Roth IRA, your income must be less than $153,000 for single filers and $228,000 for married couples filing jointly. These accounts offer a unique opportunity for tax-free growth, giving you the benefit of potential tax-free withdrawals in retirement, creating a strong financial safety net for your future. Number 5, invest in bonds. Bonds, often considered the less glamorous cousins of stocks, have their place in the world of investing. They are essentially like promissory notes between lenders and borrowers and are widely used by businesses and governments to finance projects and operations. When you buy bonds, you lend money to the issuer, and the issuer pays you interest until the bond matures, when your principal is returned to you. Bonds are generally considered safer than stocks, but have relatively low yields. It is important to note that bond prices can fall when interest rates rise, which will affect the value of your investment. While bonds may not offer the excitement of high-risk, high-return investments, they can be a valuable part of a diversified investment portfolio. Its stability can provide a feeling of security, especially in times of economic uncertainty. Number 4, invest in stocks. Stocks, often associated with both potential wealth and dizzying volatility, are the cornerstone of many investment portfolios. When you invest in individual stocks, you are essentially buying part of a company, making you a partial owner. Unlike the investment options discussed above, stocks are the riskiest type of asset. The value of its shares may fluctuate based on the company's performance and investors' perceptions of its future potential. One of the most compelling reasons to invest in stocks is the potential for substantial returns as companies grow and generate greater profits. This flexibility allows you to adjust your investment strategy according to market conditions. However, stock liquidity can also be a double-edged sword. Emotional reactions can lead to financial losses because many investors tend to buy high and sell low as they panic in response to market fluctuations. Number 3, invest in real estate. Investing in real estate is a powerful wealth-building strategy, and with $10,000, you can embark on this adventure. While traditional real estate may require a larger investment, you can explore options like house hacking or real estate investment trust, REITs, with a smaller initial outlay. House hacking allows you to purchase a property, often with an FHA loan, and rent out part of it while you live there, creating a source of income. Alternatively, REITs are an investment in companies that own and manage income-producing real estate. They offer a route to real estate investment without requiring a significant capital investment. Real estate investments can provide multiple financial benefits, including appreciation, depreciation, cash flow, and potential tax benefits. Whether you invest in physical properties or REITs, real estate can diversify your investment portfolio and offer substantial return potential. Number 2, invest in index funds or ETFs. Index funds are funds that represent a theoretical segment of the market. They're designed to act like the performance and composition of a financial market index. ETFs are baskets of assets that trade like securities. They can be bought and sold on an open stock exchange, just like common stocks. If you prefer a more diversified approach without the roller coaster of individual stocks, index funds and exchange-traded funds, ETFs, may be your ideal choice. These investment vehicles allow you to invest in a wide range of stocks, providing a level of diversification that reduces risk. By spreading your investments across multiple companies, you can reduce your exposure to the risk associated with individual stocks and potentially achieve consistent returns over the long term. Number 1, build an emergency fund. An emergency fund is crucial to your financial health. When you face unexpected expenses, such as job loss, medical bills, or unexpected home or car repairs, your emergency fund will keep your budget from taking a hit or going into debt. To achieve this, calculate the required amount and create a budget to determine monthly savings. Set up automatic transfers and cut unnecessary expenses. Open a high-yield savings account to maximize interest earnings. Some high-yield savings accounts now offer an annual percentage yield, APY, of around 5%, a return we haven't seen since the 1990s. Additionally, these accounts are typically FDIC insured, so there is practically no current risk. That's all for today. Let us know your views in the comment section below, and don't forget to like this video before leaving. Thanks for watching.